Hello everyone, Clifford Bennett, Chief Economist, ACY Securities on this beautiful Friday afternoon in Sydney, Australia. Wherever you are in the world, I hope you're having as nice a day as we're fortunate enough to be having here. We've had a lot of rain of late, so it's a nice change. Of course, I've put this big ship in the background because the big ship of the day is going to be the US jobs data out in the New York session, of course. And a lot of people are putting a lot of emphasis on this, as they always do. But as I always like to point out, it is the most lagging of all economic indicators, and probably, given the current COVID environment, post-COVID environment, and all the dislocation that's occurring with the Great Resignation and people simply going out on their own and trying their hand at their own businesses, I do actually think, from an pure economic point of view, this is the most useless piece of economic data you're likely to see in the coming week, month, or even year. But alas, everyone will pay great attention to it regardless of its true value, because it's become a little bit of a festival, this US jobs data series. And so we're going to see probably, I think, some significant volatility on the release of the data. And at first, if the data disappoints, which it well could, because you've got to remember that new jobless claims have been increasing while job vacancies have been going up. Job vacancies have been declining. So there is a chance there's a little bit of a negative surprise on the economic front in this data number. But again, it's not really that relevant. There's a lot more happening in consumer confidence, factory orders, those sorts of things. Okay, so if it does disappoint, it will only likely lead to a short-term fall, but then for a lot of people to start spinning it as a miraculous positive yet again, because it means the Fed will slow down on its rate hikes. The Fed is not going to slow down on its rate hikes, no matter the economic data at the moment. Even though the US is in recession, apart from the employment aspect of that, the US economy is already in recession, as we all know. And still the Fed is keen to keep hiking by 75 points. So I don't see a US jobs data changing that course at all in terms of Fed action, but we will see many a pundit try to spin it that it will. And please do not take any stock of all those telling you that next year the US will be cutting rates. It won't be. Inflation is at 9.1%. The Fed target is 2%. There's not going to be any miraculous return, even if the conflict in Ukraine finished this weekend. You're not going to see inflation back below 5% for the next 12 months, and the Fed will continue to fight that fight. So, very difficult to see what actually happens. I think there could be, if it was disappointing data, you'd see a move down, then a big move up, and then you might see the top of this equity market rally. I think overall it's still a bear trend. Should the data disappoint severely, we could have already seen the top in this equity market rally. So it's very much a day to be on our toes. It's going to be volatile. People are going to make much ado out of nothing, to be honest. But again, it could be a catalyst for an equity market high. But in the short term, we'll probably see people just wanting to buy anyway, regardless what the number is. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.